Hey guys, through this video I am going to discuss about liquidity ratios. So there are numerous financial ratios, but firstly I will cover liquidity ratios. Numerically these ratios are easy to calculate, but oftentimes it becomes difficult to analyze the financial ratios. So let's get started. Liquidity ratio. It helps to understand the level of liquidity risk the company is facing and the ability of the company to pay off its obligations. There are different types of ratios which include current ratio, quick ratio, operating cash flow to current liabilities ratio, account receivable turnover and inventory turnover ratio. There is one more ratio which is the account payable turnover ratio. Current ratio, it's equal to current assets divided by the current liability. So here is an example which has been extracted from 2019 balance sheet of Samsung company, and the current assets involve cash and short-term investments, account receivables, total inventory, prepaid expenses and other current asset. Current liabilities of Samsung company includes account payable, accrued expenses, note payable, current portion of long-term debt and other current liabilities. So as you can see the formula, current ratio is equal to the total current assets divided by the total current liability, and the amount of current ratio which is calculated is equal to 2.84:1. So what does that mean? It means that obviously the company is having more current assets to pay off its current obligations. Higher the number, better it is. Usually we analyze the ratio in this way. But, well, it can be in most of the cases. However, if we take step further and I say that economy is in depression, a state where customers are finding it difficult to pay for the products, or maybe they are unwilling to purchase because they don't have money. So what will happen to the current ratio at that time? Now, if the economy is in depression, that would certainly mean that the company is not able to sell the inventory faster. So let's say that it's a period of depression and the inventory of the Samsung company increases to 35 million. Now, what will happen to the current ratio? Obviously, if the inventory has increased, it will increase the current assets. Now, if the current assets have increased, that is the numerator in the ratio has increased, then the denominator, the current ratio will also increase. So again, from that perspective, that current ratio is higher and it will be better because current assets are more than current liability. But the question arises, well, the company is liquid enough or not? Obviously, in this state, company is finding it difficult to sell off its inventory, right? And it will take more time for them to convert that inventory into cash. So here the company is less liquid. And it is for this reason we calculate the quick ratio or the acid test ratio. Quick ratio. Usually what happens is that the formula states that current assets minus inventory minus the prepaid expenses divided by the current liability. You can use that formula, but it is important to understand the concept. When we talk about quick ratio, we are finding the liquidity position of the company, right? How quickly the assets are able to dissolve itself. And it will include only those assets which are easy to convert. It may be cash and cash equivalent, it may be current marketable securities and account receivable. right? You cannot include inventory in it because it is not possible for company to sell the inventory at a much faster pace, as in within a period of 30 days or 40 days. It will depend upon the demand, it will depend upon market conditions. So we exclude that item. We exclude the prepaid expenses. We exclude the other current assets, maybe uh, anything regarding expenses that have been already paid, or any such other item other than this cash and cash equivalent, current marketable security, and account receivable are excluded while calculating quick ratio. So taking the previous example of Samsung company, we calculate the quick ratio, and considering what are the current liabilities of the company, the ratio comes out to be 2.2 is to 1. Now, this means that the Samsung is in a position of a high liquidity because the ratio is more than 1, because your quick assets, here, are more than the current liabilities. You will be able to meet your obligations. So this is the basic difference between current ratio and quick ratio, because here you won't take the element of inventory, you won't take an element of any other current asset that will take more than usual time to get converted. When I say more than usual time, I'm not talking about non-current assets. Don't confuse in that, because current assets are one that are getting converted into cash within a period of 1 year. So I'm saying those assets which are typically having a less conversion period than the inventories, than the other current assets, and other than the prepaid expenses. Now, the next ratio is operating cash flow to current liabilities ratio. Again, considering the same example of Samsung company, here's an extracted cash flow from operating activities. This is the position of the company in 2019. Now, the formula says that it is net cash flow from operations divided by the current liabilities. The ratio comes out to be 0.720 is to 1. Now, the ratio is less than 1. This means if Samsung company is completely dependent upon its cash from operating activities, it wouldn't have enough capacity to meet its current obligations. However, maybe it is having other current assets as well to meet the current liability. But when you talk about long run, it is important for company to increase its cash flow from operating activities so that it does not find it difficult to meet its short-term obligation. Now, the next ratio is accounts receivable turnover ratio. Now, it's basically calculated to find out in how many days the company will be able to receive or collect payment from customers. So, taking a hypothetical example where it states that suppose in the year 2017, Happy Mart is having $100,000 gross credit sales and the return is $10,000. The starting and the ending inventory is amounting to $10,000 and $15,000, and you are asked to calculate how many times Happy Mart will be able to collect its average account receivable. Now, when we talk about the calculation and analysis, we say that the formula says account receivable turnover ratio is equal to net credit sale divided by the net average account receivable. Net credit sale is you are subtracting any sort of sales return or sales discount from your credit sales. And net account receivable is you are subtracting any kind of allowance for doubtful debt from your account receivable. And when I talk about average, it is basically the opening account receivable plus the ending account receivable divided by 2. After that calculation, it comes out to be 7.2. Now, simple answer is that it takes 7.2 times in a year for Happy Mart to collect its receivable. But to make it more sensible, if I say that let's compare it with the competitors of Happy Mart or look at the trend of the company, the situation or the analysis will be somehow different. So for that, you need to calculate days sale outstanding, right? So it is basically the total number of days in a year divided by the account receivable turnover ratio. So the amount is 50.69 days. So it takes around 50.69 days for the company to collect payment from the customer. Now, you can compare the company's performance, that is, do a trend analysis comparing what was the days the company was collecting payment from customers in the previous years, or you can have a comparison with the competitors. So I say that suppose Happy Mart account receivable ratio was 5.6 in year 2018, 6.5 in 2019, and currently it is at 7.2. So this ratio indicates that now the company is taking more time to collect from its customer, right? So the reason could be either the company has changed the policy and given more time for customers to pay, or there can be a situation where customers are finding it difficult to pay back to the company, right? Similarly, if you are an analyst or uh, you are being asked to compare the performance of the company with the competitor, maybe an XYZ, a competitor of Happy Mart, is having day sales outstanding equal to 62 days. It means that the XYZ company is taking more time to collect payment from the customers as compared to Happy Mart. Now, inventory turnover ratio. Again, inventory turnover ratio will tell you how much time the company takes to convert the inventory into cash. Example, suppose the Home Depot is reporting a revenue of 110.2 billion and the cost of goods sold is 72.7 and the inventory balance is given for the same. So now what will happen? If we look at the example and the calculation, we will often find two formula. One is using sales divided by the ending inventory and other is using the cost of goods sold divided by the average inventory. So here the reason for using the second formula, that is cost of goods sold divided by the average inventory, is that inventory is recorded at cost in the balance sheet. When you report an inventory for the company, it is not at the selling price, but it is at the book value. So whenever you are given a choice between sales or cost of goods sold, one should always go for cost of goods sold for the calculation. And the reason is that the inventory is reported at the book value. So it is appropriate for the decision, for the analysis, that the cost of goods sold is used as a formula to calculate inventory turnover ratio. Now, after the calculation, it turns out to be 5 times. So, like in a year, it will take 5 times for the company to convert the inventory into cash. To make it more relatable, we can calculate days sales of inventory. It is equal to total number of days in a year divided by the inventory turnover ratio, which is 73 days. Now, so it means that for Home Depot, if it's going to sell a product A, it will take 73 days for the company to sell the product A to the customers. Now, let's say that you are an investor and there is one firm which has days sales of inventory amounting to 73 days, and there is firm X with days sale inventory of 60 days. Now, how will you analyze or how would you state that which firm is better at its liquidity position? Does that mean a lower sales of inventory will lead to a better liquidity position? Well, not necessary, because it may be that the profit margin of one company is more as compared to other, right? Suppose the firm I am talking about, firm A and firm X, maybe firm A is having a higher profit margin as compared to X. But what if they are selling same product? Let's say firm X and firm A are selling oranges. And as I stated earlier, firm A is having day sale inventory of 73 days and firm X is having day sale inventory of 60 days. Now, since the product is same, more or less, obviously the cost of production, the revenues will almost be the same. So here we will select firm with a lower day sales of inventory, which is firm X, because it is better in putting the product shelf and selling it off to the customers. Now, account payable turnover ratio. Now, what does this ratio means? It is basically how much time company takes to pay off to its suppliers. Now, suppose a question is that Joe Mart has made a credit purchases from its supplier amounting to 40 million, and the average account payable is 4 million. Now, the formula says that purchases from supplier on credit divided by the average account payable. Again, you are talking about the credit purchases, and average account payable is opening payable plus closing divided by 2. Now, that comes out to be 10 times. So, analysis is that it will take company 10 times in a year to pay off its obligation. Now, you can again compare it with other competitors. You can compare it within the company. You can understand the trend of the company in paying off to its supplier. Now, for that, you need to calculate days payable outstanding. It is the total number of days in a year divided by 10, that is 36.5 days. So this means that Joe Mart will have 36.5 days, or it will take 36.5 days to pay to its suppliers. Right? Now, let's say you are the supplier who is supplying a particular product B to the competitors, right? And you say that, okay, let's say that Joe Mart has been taking 36.5 days to pay for the product. And there are other two competitors, Horlicks and Vortex. Horlicks days payable outstanding is 50 days and Vortex days payable outstanding is 55 days. So if you are a supplier or if you are an analyst, what will be your opinion on this? Because there are three different companies with three different days payable outstanding. And you are the one who is going to sell the product on credit. So obviously, as a supplier or as an analyst, advice would be to go for the company who is taking less time to pay you back. Or the other way is to analyze the trend of the company. What if the Joe Mart's days payable outstanding in earlier year was 29 days and then it came to 32 days and now it is 36.5 days? Now it means the company is taking longer time to pay back to the suppliers. And it may be due to the reason that the company wants to retain the cash for reinvestment, or maybe company is facing difficulties in paying the short-term obligations. So there you need to see that whether it would be beneficial for the supplier to supply products on credit to Jomart or not. So this is it. Thank you for watching the video. If you like it, please hit the like button, subscribe to my channel, and I'll be back with the next video. Thank you.